Next thing we're going to talk about is investing in emerging markets. I've been to a couple of conferences recently, and everyone's saying, my God, equity markets are so expensive in the United States, and we all know Europe is having its problems. If you really want good valuations right now, given the fact that the carry trade isn't quite what it was, and a lot of these emerging markets haven't really done much recently, go to the emerging markets, and particularly go back to the BRICS. One of the biggest BRICS, of course, is Brazil, but there are many of emerging markets out there, obviously. A cyclically adjusted ratio, and you can see kind of where we are. Look, the US looks expensive. Japan looks expensive. Developed Europe, okay, not so expensive, but then again, you know, it has its problems, demographically not going anywhere. Certainly emerging markets looks much better from a demographic point of view. So why don't we go down and get some of these EMs? Let's invest in them. I mean, you know, you want to invest in Facebook, you're paying $1, basically $15 for every $1 in current sales. In many of these other countries, you can spend $2 for every $1 in current sales. Which would you rather do? Which is cheaper? Which makes more sense? Particularly in these countries that are demographically a little bit younger than the United States or the high-income countries. Well, it seems like a no-brainer. My point is just this, though. Be careful and watch before you leap. Brazil seems like a tempting country. Actually, valued in dollars, its GDP is still lower than it was in 2011. This is a country that's been through a huge recession. It's been through two and a half years of negative GDP growth. You gotta say, this looks like a great rebound story. But wait, politically, you've got Lula da Silva, their huge leader for, 8, 9, 10 years, a big populist leader heading for jail. You've got Dilma Rousseff, the last leader, heading for jail. You got the current president being threatened himself by corruption charges. And more to the point, Michael Temer, who's the current president, has failed in his effort to get pension reform. And why is that important? So you got political instability big time in this country, and you've got the failure to enact pension reform. Why is this important? Because a lot of these emerging markets, although they're still young, are about to age incredibly rapidly. Remember that as recently as 1980, Brazil still had a 4.0 TFR, a 4.0 total fertility rate. They're now down slightly below the US today. That means they have a huge older population, which is just coming on stream, and very few workers. This is very similar to China, very similar to many of the Southeast Asian countries. And much of Latin America is the same way. In addition, Brazil, and is a terrible case of that, is locked into the most absurdly generous retirement system the world has ever known. This was promised actually by their 1988 constitution. They were still a young country. They could promise anything. And it was gradually put into law by Lula, and then gradually became an actual benefit system guaranteed to all Brazilians. The mean retirement age for men in Brazil today is 56, and for women it's 53. You are guaranteed to retire at age 65 at the latest, but you can also retire after 30 years of work. So if you start in your early 20s, you get to retire in your early 50s. This doesn't even include all of their public sector unions and so on, and retirement schemes which are even more generous. You can retire with 70% of pre-retirement wages. This means that today, between a third and a half of Brazil's public budgets are spent simply on retirement benefits, as opposed to maybe 6% on schools and infrastructure. Another huge amount of their public budget goes to the Bolsa Familia. That was another big Lula reform. Okay, so it's all going on in benefits. A lot of it's going to benefits and old people. You ever see a video of Brazilians, and in Rio and in Sao Paulo? They all look happy. I mean, Brazilians are a very happy people. I'd be happy too if we were all retiring in our early 50s. But this is bad news down the line, and this bad news is going to come soon. I'm going to show you a very interesting chart. This is from The Economist, and I think it says it all. Take a look at this. This is, you see on one axis is how old the population is. And you can see on the other axis is government spending on pension benefits as a share of GDP. And you see this roughly this line and when most nations fall. So you can see that as you get older, as the population gets older, you spend more. You see Italy, which is ridiculous. I mean, they're over 15% of GDP, and they are an old society. I mean, Italy now, its working age population is shrinking at over 1% per year. Take a look at Brazil. It's way out there. It's still a young society, but it's spending like, I don't know, like France. And its trajectory is going to go this way, okay, over time. So it is going to go in this direction, okay? That's where it's bound. Simple point. When you're looking at emerging markets, they're not all the same. And the demographic outlook combined with the political institution, first of all, the political stability, big deal in Brazil, plus the political institutions they inherit, is really important to consider here.